Hey everyone, welcome back to El Dorado FX. Today we're diving into a topic that affects all of us. Whether you're into investing, shopping, or just trying to understand what's happening with your money, we're talking about the Consumer Price Index, or CPI, and how it connects to the price of gold. If you've ever wondered why gold prices go up or down, or what CPI even means, stick around. We're breaking it all down in today's video. Let's start with the basics. What exactly is the Consumer Price Index, or CPI? Simply put, CPI measures the average change in prices over time that consumers pay for a basket of goods and services. Imagine this basket as your typical shopping list: groceries, clothes, rent, medical care, all the stuff you regularly spend money on. Each of these items has a certain weight in the CPI calculation, depending on how important it is in the average consumer's budget. For example, housing usually gets a bigger slice of the pie because most people spend a large portion of their income on it. Economists track the prices of these items over time, comparing them to a base year. The percentage change in the cost of this basket represents inflation. That's what CPI tells us. But wait, did you know there are different types of CPI? The most common one is CPI-U, which measures prices for urban consumers, about 93% of the US population. Then there's CPI-W, which is used mainly for adjusting Social Security benefits and focuses on urban wage earners. And then there's something called Core CPI, which excludes food and energy prices. These prices tend to be volatile, so Core CPI gives us a clearer picture of long-term inflation trends. Now let's talk about gold. Why does gold matter when we're talking about CPI? Gold is often seen as a hedge against inflation, meaning when inflation goes up, people buy gold to protect their wealth. When the CPI rises, indicating higher inflation, investors start worrying that their money won't buy as much as it used to. So they turn to gold, which has historically held its value. This increased demand pushes gold prices higher. On the flip side, if the CPI is low or falling, there's less fear of inflation. This can reduce the demand for gold, which might lead to lower gold prices. Here's where it gets even more interesting. The CPI doesn't just influence gold directly, it also affects interest rates. When inflation is high, central banks like the Federal Reserve might raise interest rates to cool down the economy. Higher interest rates can make non-yielding assets like gold less attractive because people can earn more from other investments like bonds. This might put downward pressure on gold prices. But if the CPI shows low inflation, central banks might lower interest rates, making gold a more appealing investment. It's all interconnected. Another key player here is currency value. When CPI rises, it can signal a weakening currency because inflation erodes purchasing power. This can make gold more attractive to foreign investors, driving up demand and prices. Since gold is priced in US dollars, a weaker dollar makes it cheaper for foreign buyers, which can push prices even higher. So keep an eye on currency movements too. They can give you clues about where gold prices might be headed. So, to wrap it all up, the CPI is a critical measure of inflation, and it has a significant impact on gold prices. Whether you're an investor or just curious about the economy, understanding this relationship can help you make smarter decisions. If you found this video helpful, don't forget to hit that like button, subscribe for more content like this, and drop a comment below if you have any questions or thoughts. Thanks for watching, and I'll see you in the next video.